How should you prepare for Social Security eventually running out of money? So I did a quick Google search before this video just to see what happens if I type in, how do I prepare for Social Security eventually running out of money? And I saw nothing there that talks about what actions someone should take. Now, a lot of people are concerned about this. And the reason they are is because when you type that in Google, all you find are fear-mongering articles about when Social Security might run out of money, why it's happening, how much it might be reduced by. The fact of the matter is something is going to change and has to change about Social Security. And so today in this video, let's address 4 key behaviors and things you can do to influence your financial stability if Social Security were to run out of money or stop entirely. So if you're new here to the channel, welcome. My name is Eric. I am the owner and founder of Peak Financial Planning. We are a fee-only fiduciary financial planning practice in Southern California. We work with clients nationwide to help them navigate the retirement risk zone and plan for financial independence in whatever form that may be for you. We make videos talking about topics like we're going into today, but also how to transition in that 10-year period before retirement so you can select an appropriate retirement target, understand how much money your saved assets and portfolio will produce for you, and have an income plan so that you can distribute your assets in the most tax efficient manner possible, among other things. If you like videos on this subject, please hit the like button, subscribe to the channel, and you'll be sure to get served more of these types of videos. And without further ado, let's jump into the 4 things you should be doing to prepare for Social Security running out of money. So if you do a quick search on Google, what should I do to prepare for Social Security when eventually running out of money? You're going to find a whole bunch of articles that I alluded to. And just to go through a few of them, most of these are going to talk about the fact that Social Security will still be around in some form, even when young people in their 20s, 30s, and 40s retire in 20 years or so, 20 plus years. The question isn't whether something will be around, it's what will it be? And as a young person, it's a big risk to take to plan for the estimates that are on our Social Security statement today with so much uncertainty that is coming ahead of us. And so, I just pulled up a few of these articles, but you can see there's a lot of fear and questioning of what might have to change. The truth is, there will have to be some kind of change. Social Security, as it's currently structured, has too few people paying in for the number of people that are getting benefits out of it. As the population in the United States continues to age, there are more and more older people claiming Social Security. And with fewer and fewer people being born, there are fewer and fewer people entering the workforce and paying into Social Security. So how do we start to prepare for this problem? Well, here are 4 ideas. We'll talk about each of them as we go through this, but let's start at the top. The first way to prepare for Social Security, and this is at any age, to prepare for Social Security running out of money, is know your numbers. When I say know your numbers, we're talking about 3 specific things that you can track at a household level that will determine your financial success. And I should say, these are independently good numbers to track, regardless of Social Security, your expectations of Social Security or not. The first is your fixed versus discretionary expenses. Fixed expenses are things that you don't have control over the amount you pay. That's something like your mortgage, your rent, your car payment. Once you commit to a mortgage, to car payment, to a rent, that is a set payment for a specific period of time based on a contract of some type. So you really can't change that. And then you have what's called discretionary expenses, and those are the expenses you choose to incur. That would be like, how often do you go out to the movies? How often do you buy steak instead of chicken? Those are things that you can control. You don't need to make any changes to these. The idea is to create a list of each and understand what's fixed and what's discretionary, because then you have the knowledge of what you can control should your projections of future income end up not coming to fruition. The second number you need to understand here is your after-tax income. We get quoted incomes if we're an employee in gross amounts. That's how much you'll get paid before taxes, before deductions, and before what your employer takes out for healthcare and all this other stuff. And that's a problem, because then we do is we plan our spending based around our income, when in actuality, we should be planning our spending based on what's left after taxes and deductions. And then the third number we need here is our savings rate. And this comes after the first 2 numbers, because what's left over after you spend, if you know your expenses, after you spend your money, what's left over is how much you save in dollars. We want to know both a percent and a dollar amount. So once we have these 3 numbers, our fixed and discretionary expenses, our after-tax income, and our savings rate, we can use these as preventative medicine. So we're planning for the possible eventuality of Social Security running out of money. but we're going to behave as though it is going to run out of money in some form or another. All right, so the second thing is, once we know our numbers, we can go move to item 2 here, which is take control of your income, expenses, and savings rate. And what I mean by that is you have to know your numbers before you can influence them, right? We want to maybe potentially go and take control of our greatest asset, which is our income, if we have that ability. Can we go get raises? Can we start a side hustle? Are we self-employed, and can we bring on new customers or increase profitability? Obviously, income is one of those dials you can tune to improve your savings rate. And obviously, the more you save, the more you can invest. And as a summary, investing should be thought of as insurance for future self running out of money, right? The more you save, the more you invest, the more insured you are about having enough money to survive till end of life. Now, expenses are the second dial you can tune. And for those of us that can't control our income, controlling expenses is going to be the other most influential dial that we can adjust in order to improve our savings rate. And I wrote here and adjust your savings rate, but obviously you have to adjust income or expenses. The third thing I didn't write here is taxes. So you can control for taxes because taxes erode at how much money you have to save. And in the future, they also erode at how much money you can take out of your investments. That is a conversation for a separate video, but the moral here is control for these 3 things. You have to know your numbers, then you can control for these. All right, item number 3 here, don't save blindly. So there's a whole bunch of videos online about you should save in this order, always max out your 401k, do this, do that. The issue here is if we aren't financially educated, we're going to default to only one strategy, and that might be the wrong strategy. Too often, clients come my way or prospects come my way, and they've only ever saved into their employer 401k. And that is a huge problem. The same can be said for if you save all your money in all cash. You don't want to do all of your funds into one place or one investment type. The problem is, obviously, if you go all cash, you're too conservative. You're not actually investing and actually getting the benefit out of the appreciation or compounding that you could be getting. Now, what level of risk is appropriate for you? That's a separate conversation. The same goes for investing all your money in your 401k. 401k is a traditional or tax-deferred account type. Now, a tax-deferred account type is really good in the current year for most people. It saves you taxes this year when you put money in. But it's really bad for all future years because you're going to pay more in taxes in the future, most likely. Less people being born in the United States. The federal government needs more and more tax money to support the aging population. People are making less money. Inflation is going up. All these things lead to being highly probable that the tax rates in our country will go up in the future. And that means if you put money in now and you're planning to pay tax on it in the future, you are likely to lose out on that bet. Now, I'm not trying to make a case not to save it all in your 401k. I'm just trying to say, if you only do one strategy, you are not hedging your bets for other eventualities. You want to put money into taxable accounts. You want to put money into Roth accounts. You may want to invest in real estate. You may want to put money into certificates of deposit, but you want to spread your money around a bunch of different buckets that all have different tax consequences. Because again, if we go back to part 2 here, your tax rate is going to have a profound impact on your future amount of distributable money. And that also is going to affect the rate or level of insurance you have were Social Security to have a problem. The fourth and final item on this list is build a plan. So these top 3 things you can really do yourself. They're really behavioral, right? It's about you knowing your numbers. Set up a QuickBooks, set up an EveryDollar, set up a Mint budget, know how much you're spending. Go look at your pay stub. You can do all that stuff. Certainly, if you need help for those things, there are fee-only financial advisors who can and will help with that. Same thing with taking control of your income and expenses. Those are behaviors. I either spend less, I go ask my boss for a raise, I put more money into a Roth account, or I go open a side hustle and I have some expenses that go through my business. There's a whole bunch of things that you can control and do there. Same thing for saving blindly. It's just a choice to make. I am not going to put all my funds and leave them in cash. I am not going to put all my funds and leave them in just my tax deferred account. So building a plan is is the point at which you might need some support or help in understanding what are the things I should do. You know what not to do. How do you know what to do? Building a plan will help you, 1, understand what is the required rate of return you need on your investments so that you can then make wise investment decisions that are connected to your level of comfort and your knowledge and understanding of the investment universe. Don't just invest blindly and reach for the highest rate of return. Don't just invest blindly and leave everything in cash. Both are bad strategies. They're pathological, on the opposite ends of the spectrum. We want something in between that comes of building a plan. The plan will help you understand, if I save this much, if I make this much, here's what rate of return I need to invest that in order to support all my financial needs out of my own saved monies without having Social Security available. And if I have Social Security available, that's awesome. We can add that to discretionary spending. I can spend it on things I want or I like. The second thing here is know what expenses can be cut. When you build that plan, you're going to create, hopefully an expense worksheet that will show you, here are the things that are fixed, here's what's discretionary, and then here's a third category. Maybe it's like a Venn diagram of things that overlap, and it's going to be something that looks like this. It's going to be fixed, discretionary, and then here's going to be the Venn diagram of things I'm willing to go without. And that matters because you have to identify those things in advance. Let's say you lose your job. Let's say you're forced to retire early, your spouse gets sick, something happens, and you actually need to adjust the plan. Well, having an idea in advance of the different types of expenses you have and having some kind of compromise with yourself, your family, your significant other about what you're willing to go without will reduce a ton of financial stress and friction, make you feel more comfortable, and then allow you to take action early on as opposed to just letting your finances bleed out. Last but not least here is building a plan allows you to build multiple what-if scenarios, right? Multiple what-if scenarios will allow you to plan for contingencies. It's if my income goes down by this much, well, I'll only cut this much of expenses. Or if I want to spend this much in retirement, well, I'll increase my savings rate by this much. And you can put those scenarios side by side and have them as kind of emergency scenarios if things change in your life, and they will. All right, so to wind this video down, those would be the top 4 items that I would be saying you should address with anybody if you're kind of concerned about the future of Social Security or other entitlement programs, but they're just generally good financial principles as well. If you'd like to me to go into more depth about any of these topics, please feel free to leave a note in the comments below. And if you have other suggestions or questions that you'd like me to make future videos on, I'm happy to do that. Please leave them in the comments below. If you like this video, please give it a like on YouTube and subscribe to the channel. And I will see you in the next video. Thank you for your time and attention.